Most people think financial disaster strikes because of reckless choices. But for financially successful families, the real danger hides in the life you've worked so hard to build. One lawsuit, one fire, one cyber attack, even how your home is titled. Any of these could undo decades of planning in an instant. And the worst part? These risks are hiding in plain sight until it's too late. Today I'll show you the hidden lifestyle liabilities I see most often in wealthy households. Exposures that could threaten everything you've built, sometimes in a single day. No scare tactics, just the exact strategies the most protected families use to safeguard their legacies. Let's start with the misconception I hear often. I pay for insurance, so I should use it. That logic makes sense until you understand how the system really works. Filing a claim, even a small one, is like taking a high-interest loan from your insurer. You will repay it through surcharges that linger for 3 to 5 years, and premiums that almost never drop back down. I've seen families who submitted 2 relatively minor claims in 1 year, both under $10,000, and their premiums skyrocketed and stayed elevated for the next 3 years. They thought they were just using what they paid for, but they ended up paying thousands more over time. The right approach isn't about spending more on insurance. It's about strategically transferring the right risks while keeping the ones you can comfortably handle. That balance is where true financial protection lies. By the way, if you want to uncover hidden risks that might be quietly threatening your wealth, check out our free quiz called Identify Blind Spots in My Financial Life. I will personally review your answers and set back a short report showing where you may be exposed. The link is below. Don't miss it. Now, let's look at how success itself can quietly expand your liability. Maybe you've added a mountain home, a beachfront property, or luxury vehicles. Maybe you entertain more, have valuable collections, or employ household staff. These are signs of achievement, but each one introduces a new layer of exposure that often goes overlooked. That mountain home, it might sit in a wildfire zone. The beachfront villa, now you are dealing with hurricane exposure. And staffing, property maintenance, and home upgrades come with hidden risks you may not have considered. These are not dramatic hypotheticals. They are the real-life vulnerabilities we see frequently. Consider a high-net-worth couple in their early 60s holding 10 to 15 million in assets. They own a primary residence and 2 vacation homes, a $250,000 wine and art collection, 3 vehicles, one of which is a collectible Porsche, a part-time housekeeper and a live-in caregiver for an aging parent, a backyard designed for entertaining, pool, pizza oven, fire pit, and more. But their insurance hasn't changed in 5 years. They still have a $2 million umbrella policy. Their wine and art are lumped under general contents. They've never reviewed their employment practices liability insurance coverage or whether it exists at all. The gap between their lifestyle and their liability protection isn't just large, it's a financial time bomb. One pool accident, one wildfire, or one wrongful termination claim could force them to liquidate assets they never intended to touch. Let's talk about wording. Specifically, the words in your policy that dictate what you are actually entitled to after a loss. Most standard insurance policies cover replacement using similar kind and quality. That might sound reassuring, but let me show you why it's not. Imagine you've invested in custom finishes, imported Italian tile, rare hardwood floors, and high-end stone countertops. If a fire or flood destroys them, similar kind might mean basic ceramic tile or prefabricated vinyl flooring. It's not a restoration, it's a downgrade. Some high-end insurance carriers use the phrase same kind and quality, which means you will get exactly what you had. And when your home includes materials or craftsmanship that are not easily replaced, that distinction can mean a 6-figure difference. This matters just as much for condo owners. Association bylaws vary dramatically. Some make you responsible for everything from drywall inward. If your policy doesn't align with those bylaws, you could be on the hook for tens of thousands in reconstruction costs. The next area where I see a huge gap is cyber insurance. We live in a digital world, and while cyber insurance used to be something only businesses worried about, that's no longer the case. Today's high-net-worth families are digitally connected in countless ways. Smart home systems and voice assistants, online investment accounts and banking apps, family members with active social media profiles, cloud-based storage of sensitive legal, tax, and health documents. Cyber criminals now focus on well-connected, financially successful households because those are the ones with the most at stake. Imagine, a spoofed email drains your checking account. Ransomware locks your smart home during a winter storm. Your teen's social media post triggers a defamation lawsuit. Personal cyber coverage isn't optional anymore. For around $500 a year, it's the cheapest legacy insurance you'll ever buy. If you own a business or real estate in an LLC, this next part is especially important. This is one of the most common mistakes I see among affluent families. You title a vehicle under an LLC for tax reasons, then let a spouse or child drive it for personal use. If there is an accident, both your business and personal assets could be pulled into the lawsuit. Or worse, you pay the commercial insurance premium with your personal card. These mistakes tear down the legal firewall between your business and personal assets. Suddenly, that lawsuit over a fender bender could threaten your family's wealth. To stay protected, only title property or vehicles under the business if they are strictly for business use. Maintain separate payment methods and accounts. Don't use your business credit card to book a personal vacation. That weakens the LLC's protection. Don't mix personal and business liability coverage. Consider both personal and commercial umbrella policies. Many owners assume their personal umbrella covers everything, but personal umbrellas do not cover business activity, and vice versa. Be cautious when hosting events at home involving business contacts or alcohol. If something goes wrong, an injury, a DUI, you may be held liable. And if your policies are not structured right, neither your homeowners nor your business policy may apply. There are certain exposures that don't feel like risks until they are. And by the time you realize it, it's usually too late. Let's start with recreational toys. You may assume your homeowner's policy covers your jet ski, ATV, or snowmobile, but the moment those leave your property or are driven by a friend or teen, you may lose that protection entirely. These toys need their own policies if you want coverage off-site. Now, let's talk about renovations. Planning a remodel? Moving out temporarily, signing a contract with a builder. These all change the risk profile of your home and could void existing coverage. Before the first hammer swings, notify your insurer and update your policy. Outdoor features come with their own risks too. Pools, pergolas, fire pits, and zip lines are often installed without realizing they require additional liability coverage. Some carriers even exclude coverage for trampolines and diving boards. And don't forget about short-term rentals. If you plan to rent out a vacation home or second property, know this. Many standard policies do not cover short-term rental activity at all. Others do, but at a premium that wipes out much of your profit. Always verify before listing. Avoiding claims is the best risk management strategy, and it's entirely within your control. Here's how the most protected families do it. Number 1, strategic deductibles. Raise deductibles to $2,500 or more if you have liquidity. This deters small claims that spike premiums. Some high-end carriers even waive deductibles entirely for major losses over $50,000. Watch for stacked deductibles, where your home, contents, and detached structures each have separate deductibles. That fire in the garage could cost you 3 deductibles. Work with a carrier that offers single event deductibles instead. Number 2, add the following smart protections that will pay for themselves by avoiding claims. Water shut-off valves that stop leaks before they ruin floors. Monitored alarms that directly alert fire or police without relying on neighbors. Arc fault detectors capable of preventing up to 50% of electrical fires. Lifeguards for pool parties, which can significantly reduce liability. Background checks for staff, contractors, and frequent guests. Number 3, self-insure select risks. For example, if your coastal home is hurricane resistant, skipping wind coverage and reserving premium savings in a rainy day fund may be smarter, especially in states with slow claims processing. Number 4, host events at insured venues, not your home. If you must host privately, get one-day liability coverage and use licensed bartenders. Number 5, if you are looking to do a renovation, notify your insurer first. Major remodels can void coverage if you move out or hire contractors. Number 6, the ask first rule for new assets. Before buying luxury cars, art, or vacation homes, talk to your financial advisor or insurance team. You might discover that $200K wine cellar isn't fully covered. The bargain mountain home costs $15,000 per year to insure, and your teen's ATV has zero liability coverage of your property. The goal isn't to live in fear, it's to protect the life you've built so you can enjoy it without invisible financial threats. Before we wrap, let's do a lightning audit of the most common and costly coverage gaps I see in the financially successful households. If any of these make you pause, it's time for a policy review. Number 1. Condos. Your buildings by laws may require you to insure everything from drywall inward. Standard policies often exclude this. Number 2. Valuables. The $200K art collection, your policy might cap payouts at $2,500 per item. Scheduled coverage is non-negotiable. Number 3. Household stuff. One wrongful termination claim from a nanny could cost $250,000. Employment practices liability insurance coverage is cheaper than the lawsuit. Number 4. Events. Hosting a 50-person party, your homeowner's policy won't cover liquor liability or vendor injuries. Number 5. Global travel. Your umbrella policy is the only coverage that follows you abroad, especially critical for families with teens or expensive gear. Number 6. Luxury cars. Agreed value plus OEM parts clauses ensure your Range Rover isn't replaced with aftermarket knockoffs. And number 7. Rebuilding costs. With construction inflation, guaranteed replacement cost is the only way to ensure you are not paying thousands out of pocket after a disaster. If even one of these risks made you pause, don't ignore it. A simple review now can save you from a six-figure loss later. And risk exposure is just one way wealth can vanish. But there is an even bigger threat I see all the time, one that quietly destroys family wealth from the inside out. In this video, I'll show you the number one mistake legacy-minded families make and how to fix it fast, before it's too late.